ratios of that. Okay, so our lecture will be restricted to this part. So before starting, let's start with the daily motivation quote. When obstacles arise, you change your direction to reach your goal. You do not change your decision to get there, right? So you can change the ways of doing the things, but you do not change your ultimate goal where you have to reach. Okay. Download Adda 24/7 app on your mobile to get the updates on various banking exams and as well as the study material plus the video lectures for various banking and government exams. Okay. Use this code Y432 to get flat discount of 77% up to 80% on various Adda products. So download it on your mobile and use this code Y432. Okay. So let's start with today's topic. Today's topic is Tier 1, Tier 2 and Tier 3 capital. Firstly, where is it used? Where is this Tier 1, Tier 2 and Tier 3 used? Okay. So with the advent of Basel norms. Now what are Basel norms? Basel norms have been put on the banks for safety of the banks. How the banks should perform, what should be the capital adequacy, so that banks don't get into the debt trap or NPA trap. Okay. And depositors don't lose their money. So for that, this Tier 1, Tier 2 and Tier 3 capital has been brought in, as well as the Basel norms have been brought in. Now we are working in Basel 3 now. Okay. So today's topic is restricted to Tier 1, Tier 2 and Tier 3 capital. Let's start. What is Tier 1 capital? Firstly, what is capital? Capital is a cushion for any organization so that if something arises, some problem arises, they can fall back on that cushion and use that money so that they're working, daily working, BAU we call it, business as usual. That is not affected. That is the basic purpose of capital. So how many types of capitals are there? As per Basel norms, there are 3 types of capitals. Tier 1, Tier 2 and Tier 3. Tier 3 is not that frequent. Tier 1 and Tier 2 are frequent. Okay. So what is Tier 1? Tier 1 capital is bank's core capital, which consists of shareholders' equity and retained earnings. It is of highest quality and can be liquidated quickly. This is the real test of bank solvency. Now understand the basic concept of Tier 1. Tier 1 means basically equity, share capital. Okay. Share capital means major portion is share capital in that. Plus there are other components. We'll be studying that in the next lecture. Plus there are other components. So majorly is equity. That is called as CET1, common equity Tier 1. Okay. So this shareholder, this equity means it's a free capital. Always remember Tier 1 is called as going concern. Going concern means it is a free capital. Okay. So shareholders equity and retained earnings. What are retained earnings? Retained earnings means if I have a profit this year and instead of distributing that profit among the shareholders as dividends or investing it somewhere for my project, what do? I keep that profit in my balance sheet as cash. And that profit is known as retained earnings. So whom does it belong to? It belongs to the company or the shareholders, right? So it is a free capital. Remember, on your shares or your earnings, do you give any compulsory payment for anyone? Means like if we have to make EMI payments on loans. So many of you might have invested in shares up till now. Do you get a fixed payment from the bank or from the company on any equity? No, right? Because it's a free capital. If the share value goes up, you earn. If the share value goes down, you don't earn, right? So retained earnings, it is of the highest quality and can be liquidated easily. Highest quality. Why is it highest quality? Because how do you decide on highest quality or lowest quality? Because highest quality means you don't have to pay anything compulsorily to the investor, right? So this is the real test of bank solvency. That's correct. Real test means what? When will you invest in any company shares? When you know that the company is doing well. Otherwise, will you invest? No, right? So this is a real test of bank solvency. People only invest in those companies which are good and performing. Okay. So that's why it's a real test. Tier 2. Tier 2 capital includes revaluation reserves, hybrid capital instruments, subordinate debts. In addition, Tier 2 incorporates general loan loss reserves and undisclosed reserves. Okay. Now, remember important part. Tier 1, what did I tell you? Tier 1 is going concern, means it is a free capital. Tier 2 is gone concern. Gone concern means what? It means you have to compulsorily pay on the capital which you have raised. So how is Tier 2 raised? Tier 2 is raised through bonds, generally, bonds or debentures. Okay. Government uses bonds and privates use debentures. So debentures, what do you mean by debentures or bonds? You take money from somebody. It's like an FD. You take money from somebody and you give him in writing that I will pay you every year this much interest, and at the end I'll pay the maturity. So you have given them in writing that you will pay the fixed interest to these guys. Okay. So when you say you are going to pay, it means it's a binding on you now. So that's why Tier 2 capital is always a gone concern. It's a compulsory payment to be given to the investor. Okay. So it includes what? Revaluation reserves. Revaluation reserves means what? Those reserves which are to be revalued, means which reserves are to be revalued. Here it's like this. Revaluation reserves means like the bonds. If I am holding something in bonds, then those bonds are subject to revaluation every time. Why? As the interest rate changes, the bond value also changes. So that's why it's called as revaluation, constant valuation. Hybrid capital instruments. Hybrid means what? Those which can be converted from equity to debt, and from debt to equity. That is called as hybrid. Okay. Then subordinate debt. Subordinate debt means what? Taken from somebody. Subordinate, right? Taken from some subordinate company or some subordinate organization, right? But in any case, you have to pay them because it's shown in your balance sheet that you have taken the loan from somebody. Okay. So Tier 2 capital is of this sort. In addition, Tier 2 capital incorporates general loan loss reserves. Loan loss reserves means what? The reserves which I have kept for some difficult situation, like there is some NPA, some loan turns bad. For that, I keep the reserve, and that reserve is also added in Tier 2 capital. And undisclosed reserves. Undisclosed is not a part of CAIIB. But what do you mean by undisclosed? Basically, those reserves which I have not shown to the fullest. Okay. Now, Tier 1 capital is intended to measure the bank's financial health. Right? Means what? Measure the bank's financial health. How do you measure the bank's financial health? Using Tier 1. Because if the financial health is good, only then the company will get a huge Tier 1 capital. If the financial health is is worst, then nobody will invest in the shares and the long-term bonds of this company. Sure, we'll be studying this tomorrow, but there is something called as PNCP, preference shares, means perpetual non-cumulative preference shares. Even those are a part of Tier 1 now. Earlier they were in a part of Tier 2, but now almost last 3-4 years, RBI has classified them into Tier 1. So these are long-term bonds. So will you invest in any company shares or long-term bonds if the company is not doing well? So that's why it is a measure of bank's financial health. Bank uses Tier 1 capital to absorb losses without ceasing business operations. Means the losses are absorbed without ceasing business, means without affecting your normal daily business. Okay. Because here, if some share value of some bank goes down, is the bank affected in any way? No. It's only the market traders and the investors are affected. Bank doesn't get affected. Okay. But if the bond value goes down, then or goes up, then the bank is affected. That's why tier 2 directly affects the bank. Tier 1 directly doesn't affect the bank. In the long run, if there's a problem in some tier 1, then in the long run, bank will be affected. But direct BAU, it's not affected. Tier 2 capital is a supplementary, less reliable than tier 1. What should be a preference if you are the owner or the chairman of any bank? What would be a preference? I would prefer to get tier 1 only. Okay, because I don't have to give compulsory payment. But tier 1 has a problem also. What is the problem in tier 1? The more you increase the number of shares, the less you get the control of the organization. There will be more people, now more owners. Shares means what? Shareholders are owners. There will be more owners of that bank. So you will have less management control. That's why that is a drawback of tier 1. So tier 2 capital is supplementary, less reliable than tier 1. A bank's total capital is calculated as a sum of tier 1 plus tier 2. Okay. So total tier 1 plus tier 2 is equals to total capital. But tier 3 is not included over here because tier 3 is a urgent capital. Okay. In case of market risk, due to some problem arises due to market risk, only then tier 3 comes in picture. But that is not a part of total capital for this Basel calculations. The regulator uses capital ratio to determine and rank banks' capital adequacy ratio. Right. So basically capital adequacy ratio. So capital adequacy means how much capital does the bank have vis-a-vis its risk-weighted assets. So basically CRAR we use it now. Capital to risk asset ratio. So CRAR equals to total capital tier 1 plus tier 2 upon RWA. Right? RWA are related to what? Risk-weighted assets. These RWA means what? These are total of credit risk, market risk, and operations risk. Okay. Tier 3 capital consists of subordinate debt to cover market risk from trading activities. So if you have some problem in some trading activities due to market risk, remember market risk means here there are 3 types of risks basically: credit, market, and operations. Credit and operations are in your hands. How to control them, how to minimize them, but market risk is not in your hands. Market risk is due to market, means rate of interest reduced by RBI. Is it in your hand? Or CRR reduced by RBI, increased by RBI. Is it in your hand? Nothing. In some problem arises and the Fed increases the rates. Is it in your hand? No. So market risk is outside your control. And that's why tier 3 is kept only for market risk. It is not kept for operation and market and this credit risk. Means if you face some problem in credit risk, you can't raise the tier 3 capital. Similarly, if you face the problem in this operations risk, you can't raise the tier 3 capital. But if you face the problem in market risk, then you can raise the tier 3 capital. Now, the various ratios for tier 2, tier 1, tier 3. Okay. Tier 2 is limited to 100% of tier 1. Means what? What does it mean? Tier 2 cannot be greater than tier 1. Okay. So in other words, tier 2 capital cannot be greater than tier 1. See here, why is this important? Because in exam, you'll get a case study. I've taken that case study also in one of my lectures. In exam, they'll give you a case study in which tier 1 capital will be roughly 1000 crores and tier 2 will be around 1200 crores. And then you will be told to calculate the total capital. So total capital will be 1000 plus 1000 only. Even though tier 2 is 1200, you will have to take only 1000. Why? Because tier 2 cannot be greater than tier 1. Keep it simple. Okay. Then tier 3 capital can only be used to support market risk capital requirements. Means tier 3 can be used only to support market risk. That's what we told earlier. Okay. Now tier 3 is limited to what? See here. Now these figures are very important for you. Tier 3 is limited to 250% of tier 1. Remember, tier 3 is limited to 250% of tier 1. Tier 1 capital being applied to market risk exposures. So tier 3 is always applied to market risk exposures, and it is limited to 250% of tier 1. It means what? If my tier 1 capital is, let's say, 1000 crores, then my tier 3, which I'll be raising for market risk problems, it can't be more than 250% of 1000. So what is that? 250% of 1000. So it is 2500 crores. Okay. If my tier 1 is 1000 crores, tier 3 cannot be more than 2500 crores. This is a very important point. Okay. Second point. If tier 3 capital is used for capital adequacy, then any tier 2 capital also used for the same counts towards 250% limit. Okay, that is okay. This is not for your CAIIB part. Only CAIIB part is this 250% of tier 1. Okay, and the important part, last one. The minimum tier 1 capital needed for market risk ends up being about 21.85%. This is very important figure. Means what? It means that your total market risk, let's say it is 200 crores. Okay, means total market risk is 200 crores. So in that case, what should be a tier 1? Here, it's like this. Total market risk of this 200 crores, out of that, 28.5% of this market risk should be covered by tier 1 capital. Got this point? In any case, your market risk of 200 crores, let's say 100 crores, easy, keep it easy. So 100 crores market risk, out of that 28.5 crores of this market risk should be covered by tier 1 only. Okay, and the remaining part means how much does it remain? 71.5, right? For that remaining part, you should use tier 3 if tier 2 is not sufficient. Tier 3 is the last option, always remember. First, you'll have to try to manage with tier 1 and tier 2 only. If tier 2, this 71.5 which is remaining, if tier 2 is not possible for the 71.5, then you have to raise tier 3. But remember, tier 3 is raised only when we have a market risk exposure, right? We should have a market risk exposure. If you have a credit risk or operations risk exposure, then you can't use tier 3 capital. So what is firstly capital, credit risk and market risk and operations risk? Can anyone tell me? See this. Credit risk means basically there are two parts in credit risks. One is country risk, second is counterparty risk. Okay. Country risk means what? Country risk again has one more subdivision to it, that is called as sovereign risk. Okay. Country risk means what basically? Country risk means the company on which you are taking the exposure lies in some country. So how is that country performing? If the company is good, but the country is not performing well, then again there is a huge credit risk. Because what happens? Someday some owner, this prime minister, president, or any owner of that, not owner actually, the leader of that company, of that country will declare that we won't be giving any funds, sending any foreign exchange from today night. This has happened in Pakistan once when Musharraf took over as a military ruler. He immediately declared that no foreign funds will be transferred from Pakistan. So if you have some exposure on some country in that Pakistan during that time, so what will you are at loss because you won't receive the funds because no foreign funds will be transferred from that country. So that's why country risk is very important. After that country risk comes sovereign risk. Sovereign risk is related to state. Always remember. Okay. So even though in any country, some state might put some legalizations on certain area. Means in India it's very difficult because we have a central government and that decides the policies. But for example, in US, there the states are, US is the union of these states. So what happens in that country? Some governor of that state does have a right to put some legislation, but India it doesn't have. So no this chief minister of any country of any state can put a binding that we won't transfer any funds, means forex funds from our state from today night. It can't be done over here. Okay. So understand this. Country risk and second is counterparty risk. Counterparty risk means the country is good, but the company on which you are taking the exposure is not performing well or is a fraud. So that you have to check. Then what is market risk? Market risk means that risk which is outside your control, like interest rate risk, basis risk, and means some changes in the forex rates, changes in some rates of some US government. So nothing is in your hands, right? Or even the stock market risk, that is a part of market risk, right? And third is operations risk. Operation risk means what? Operation risk is related to operations. Now, don't ever think that operation risk is only limited to employee risk. Means employee making some mistake. No, it's not that. Operation mistake by the employees or errors by the employees is a part of that operations risk. But operations risk also includes like floods, dacoity, or any famine or terrorist attack or your system failures. That is also a part of operations risk. Means nothing only related to employee errors. It's related to other things also. Okay. So that is operations risk. Okay. So that was just to explain you all these three risks. So what was the today's lecture for? Basically, what did you take? What are the takeaways, key takeaways from this lecture? The key takeaways are meaning of tier 1 capital, meaning of tier 2 capital, meaning of tier 3 capital. Then why is tier 1 capital more important than tier 2? What should a company prefer to? Okay. Then how the tier 1 is measured, that CRAR formula which we took. Then next we have the percentages of all these things. Percentages means tier 2 should not be more than tier 1 in any case. If it is given more than tier 1, you have to curtail it to maximum tier 1. Okay. Then tier 3 capitals percentages means which are the tier 3 capitals percentages? This 250%. It is limited to 250% of tier 1, number 1. Number 2, the market risk should be covered by at least 28.5% of tier 1 capital. Okay. So these were the key takeaways, and that's what the purpose of today's lecture was. Okay. So we'll stop over here now. Okay.